Good morning, everyone. This is Marshall Giller bringing you the morning comment for April 8th. Well, the effect of the much worse than expected non-farm payrolls on the dollar is now almost totally gone, at least with regards to the G10 currencies. Fed funds rate expectations are now down only 3 or 4 basis points from the pre-NFP levels, while 10-year yields are down 3 basis points. It's almost as if the NFP never happened. Apparently, investors listened to what the FOMC members said and are expecting the Fed to look through this period of weakness and begin tightening rates around mid-year anyway. That means the dollar rally can continue. The job opening and labor turnover survey yesterday showed job openings rising to a 14-year high, but the hiring rate was unchanged and the quit rate fell a bit. These are key indicators of labor market conditions for Fed Chair Janet Yellen, as they're closely correlated with employment costs. I've got a graph of this on our website. These details should have depressed the Fed funds rate expectations slightly, but didn't. Apparently, the markets were more encouraged by the good headline figure on job openings, plus the solid rise in consumer credit in February and the improvement in the IBD-TIPP Economic Optimism Index, which we don't follow very closely, but apparently some people do. That's another sign that the mood for the dollar is turned. The Bank of Japan kept its monetary policy stance unchanged, as was unanimously expected, so I won't discuss that in much detail. FX market participants are waiting for the April 30th meeting, when the BOJ will release its semi-annual outlook for economic activity and prices. If the inflation forecast is revised sharply downward or fears are expressed about overseas economies, Governor Kuroda could propose further easing measures then. As for today's highlights, we already had a surprising decline in German factory orders for February, this for the second month in a row. That sent euro-dollar down slightly. Now, Greece will auction off 875 million euros in 6-month T-bills. The money is needed to refinance a 1.4 billion issue that matures next Tuesday, not to mention a 194 million bond coupon payment and a 1 billion euro T-bill maturity the following Friday. This is besides the 450 million euros due to the IMF on Thursday that Greece has promised to pay. Greece is rapidly running out of money and therefore also running out of time to reach some agreement with its creditors. Otherwise, a default seems inevitable, and that would just be a disaster. In the U.S., the minutes of the March FOMC meeting are to be released. This is the meeting when officials removed the patient phrase from their statement. It'll be interesting to see the discussions that led to this revision. I believe that September is the most likely date for the Fed to start raising rates, and the dollar is likely to regain its strength by then, especially as alternatives within the G10 become less attractive with their easing biases. And the U.S. earnings season starts today. We're likely to get a number of comments about how the strength of the dollar is hurting earnings. Nevertheless, remember that the U.S. economy relies very little on exports, so this is not likely to be a determining factor in Fed thinking. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Giller, head of Global FX Strategy at IronFX Global, wishing you solid trading.